Good morning or afternoon, everyone, whatever the case may be. This is our regularly scheduled Zoom webinar for the Financial Security for All community of practice. Thank you for joining today. And our topic today is taxes. We'll be talking about some of the new tax law changes. We are so thrilled to have one of our own joining us today, Andrew Zumwalt from University of Missouri. Andrew has a business and family consumer economics degrees, and he's on faculty with University of Missouri, and he has a long and successful history of tax outreach education and works through the VITA sites there in Missouri, MoTax. And so we're really delighted to have someone with that background to talk to us today about outreach education, about some of the tax law changes, and also he's going to be talking about the tax advantaged accounts and purchasing health insurance in the marketplace, something that has constantly been updated. Wanted to mention, also wanted to read this, the taxpayer assistance as a gateway to financial education that Andrew has been doing over the past 6 years. More than 20,000 returns and more than $20 million has been refunded. So that's a great number and dollar impact, in addition to the knowledge and skills gained in the personal finance education outreach that Andrew has been doing through that program. So please join me in welcoming today Andrew Zumwalt.
Well, thank you very much, Laura. It's always awesome to hear somebody kind of sing your praises. So thank you for that. Especially need that after the end of tax season, because it was a kind of a long tax season. Is this coming across correctly?
No, and go back to slideshow.
Take it out of narration pane.
And take it out of the narration pane.
Will that work?
Maybe Andrew, try closing this out. Stop share and make sure that you have it on the view that you want before you share. So go take it out of the narration view, make sure it's on the view you want, and then go to share screen.
There we go. Okay.
Now, not seeing it yet. There, it's coming.
There we go.
There, perfect.
All right. Thank you about that. Couldn't have a Zoom presentation without a little bit of stickiness. So, as Laura said, taxes more than a postcard. And here's kind of the postcard that was proposed. And so you can see we've got some simplified pieces here with just wages and other income, and kind of bringing it down to taxable income, and then figuring out what the taxes are, what your credits are, kind of netting those against each other, and then figuring out if your taxes are withheld or bounced due. So we know that this really wasn't going to work. We need to have more than a postcard. And so with that, I'd like to end today and thank you all for coming. No, I'm just kidding, just kidding. When we talk about taxes, it can be kind of dry, especially when we talk a lot about taxes. And so I try and interject a little bit of humor into taxes, because there's so much there, and there's so many exciting possibilities, but it's easy just to think it's boring. So I like to kind of make it fun a little bit. Thank you, Laura, for the introduction. I'm just going to go ahead and skip this slide and kind of talk a little bit about that postcard. I think the postcard idea looks good, and it may have some good ideas behind it, but we might be coming across the wrong way. So I want to talk a little bit about that postcard philosophy, MoTax, and some of the opportunities we have in Missouri. Talk a little bit about the tax law changes. I know everybody's kind of seen a lot of different areas, but I'm going to try and cover some of that. And then talk about kind of the marketplace and retirement and money origins. So we talk a lot about where to pull money from in retirement and the strategies of where you pull the money first, which accounts do you pull from first. But I think it's useful to talk a little bit about how that impacts the marketplace. It's another variable that's now affecting everybody else. So let's jump right in. So here's that postcard again. Really, when I teach taxes, when I do my tax trainings, I kind of use a model like this because I think it's useful to see that taxes really aren't that complicated. We add up all the income, we subtract some things, we calculate the tax, we put some credits against it, and then you get a refund or a balance due. If we were to take a tax form and simplify it down, it would look a lot like this. The problem is that it's just not simple enough, really. So, for example, on that postcard, there's no place for social security numbers. Just a little bit of history, and this is actually fun, or maybe this is going to help you on the weekend when you're at your cocktail hour. In 1987, they started requiring SSNs for dependents on tax returns, and 7 million children disappeared from the returns. They didn't have numbers, and so they just weren't listed in 87 or 88, but they were there the year before. And in fact, the IRS wasn't verifying some SSNs until the 90s. And I know this because my parents, my father swears that he got a social security number for me when I was born. But we had this number. We went to the Social Security office and they said, that's not your number, after the IRS had rejected my parents' return. And so I finally got a number sometime in the late 80s because my parents had been using this fake number for years and didn't know it. The IRS kind of just told them later on in the 90s. So we've had this social requirement since the 80s. It's now they're checking it. And in fact, now when we file electronically, your social security number and the first 4 characters of your last name must match. We have some problems at the VITA sites with families with multiple last names. So where does the middle name stop and the last name begin? And so we kind of struggle sometimes to figure out what that last name is, but all we have to do is match the first 4 of the last name, the first 4 characters and their social, and it works. If you're gonna go the earned income credit route, then you have to match socials, first 4 characters and the year of birth. So it's even more complicated. So the postcard, there's no place for that. Now, there's just not enough space. And one of the reasons why, in addition to the requirements for SSNs, is we love to shove social policy through the tax code. So, on that postcard, where would we put withdrawals from retirement accounts that were non-qualified and therefore there'd be a tax? There's a line for education credits. Well, which education credit? Moving expenses, where would we put that? And I know moving expenses are gone for 2018, but we still have them for military personnel who have a permanent change of station. We have all these little pieces of our tax code that don't look too bad just alone, but when you pile them all together, it's huge. And so I think the real power of the postcard was simplification. And I think if we kind of just ditch the postcard idea and say, okay, that was never going to fly. What's the real next step? What can we actually do? And you've probably never been to a presentation where Estonia, which is on the eastern edge of Europe, was highlighted as a great idea. Like they're kind of leaders in this field, actually. They have something called the X Road, and they connect all these private and public institutions together so that when someone goes out and they need to pay their taxes, well, they just go online. When they vote, they go online. When they need to sign up for services, they go online. All their healthcare is online. It's just amazing that their whole social system is tied together via this X Road. They have strong security. Everybody has a number, but it's never used to authenticate you. It's only used to identify you. They have pre-filled tax returns. So when they go online to file their tax return, they're logging into the system. Everything's already really been reported to the government. So they just go in, check that it's right, and then mark a box, call it good. And this isn't that far-fetched. California had something called Ready Return, where California was already collecting a lot of this information. And so they could actually present you with a return and say, hey, this is your return. Does this look good? And you could say, yeah, I think that's great. And then you could send it in. And I believe that's now been folded into something called CalFile, But we had this pre-filed idea in the US for some time. Now, who do you think doesn't like this idea? I'll give you a second to think about it. CPAs, yeah. Accountants, yeah. I think there's a little bit of a pushback from there. I think if you kind of look at some of this, the paid taxpayers, there it is, the tax software companies. I think you still might need advice. And so CPAs and accountants would still be there to provide you with the advice, like what moves should you make? But I believe Intuit and some of the other larger players were heavily against this idea. They wanted to be that intermediary that files your tax return and not someone like the state. So if you want more information, there is a great NPR Planet Money podcast, episode 760, Tax Hero. And it's all about the gentleman who actually put Ready Return in place for California and the struggles he went through to get it in the law. If you want to learn more about the X Road, that's actually a link to an Estonian document that kind of highlights what they've done and the benefits it provides to their country. But I think it's a great example of what we could be doing if we trusted each other a little bit more and if we had some better security in place. So just kind of sharing that a little bit. It's just kind of extra bonus when we talk about taxes. The postcard, not a great idea, but I think the idea of simplification behind it is possible. I think we can get there. Okay, and I am going to say I've got a link to all these slides in my last slide. I'll try and dump it in the chat, so don't worry about copying down all this information or taking notes. It will all be available. Now, I do want to talk a little bit about the Missouri Taxpayer Education Initiative. It is something that I have spent a lot of time working on. It started back in 2003 or 4 with Dr. Sandra Houston and Brenda Proctor. They kind of jump-started it from what it was at the University of Missouri. And then Dr. Houston moved on, and Brenda Proctor kind of moved on to other projects as well. And so I was kind of brought in to run the program, and we grew it from small sites across the state to much larger sites. And so what we do is we leverage VITA, the Volunteer Income Tax Assistance, and that's where volunteers are working face-to-face with clients to prepare their tax returns. We leverage that program and the trust it builds to provide financial education. So once someone has shared their financial life with us, they're trusting us quite a bit. I mean, when you think about it, just step back and think about a VITA session where a client comes in, they're sharing everything. They're sharing socials, they're sharing names, birth dates, addresses, everything is being shared. And so there's quite a lot of trust, including if they want direct deposit or direct debit, routing and account numbers. We have their financial lives in our hands a little bit. And so there's quite a lot of trust built up. So when we say, hey, have you thought about doing this action, maybe checking your credit report or asking some innocuous questions, what do you plan to do with your refund? We can have those conversations and maybe kind of guide them to one of our credit counseling sessions or financial education sessions. We try to kind of use that trust to provide financial education, and it's worked pretty well. We do have sites all across the state, so we have a heavy concentration of tax sites in Kansas City, so in the urban areas. And I'm excited to say that the specialist in Kansas City, Shitomi Luster, has actually partnered with just a variety of community organizations. And the most recent organization was actually the police department. The police department was looking to become more integrated into the community. And so they actually wanted to host a tax site. And Shitomi was able to kind of move some volunteers there. And they actually did tax returns in a police headquarters. Came with its own set of complications. They won't let you plug your computers in to their hardwired network at the police office or the police center. And so we had to kind of do some technology negotiating there. But she's had quite success in the urban areas. We've had a lot of success in rural areas. So places like Hannibal, Branson, Fredericktown, Trenton, Camdenton, all these places that are traditionally rural, we've had great success in having clients come in over the years and have their tax returns prepared via the traditional one-to-one, face-to-face VITA method. And lastly, I wanted to highlight the University of Missouri campus. We prepare about 2,000 returns or so here on campus in our program. And I include in that not only the resident alien returns, so we work with students, faculty, staff, community members. We also include more our resident aliens who come in, and we also include our numbers the non-resident aliens, because there are actually some people that kind of cross the line a little bit. They become resident aliens, but they still have tax treaty benefits from US treaties with other countries. And so we have a great relationship with the non-resident alien specialist, and we're able to kind of make some magic happen for those people, where if they went somewhere else, they just wouldn't get that specific knowledge. So we've got urban, we've got rural, and we have a college campus. So we've operated in lots of different settings. For 2018, we're still calculating, we're still pulling everything together. It looks like we're gonna be over 9,000 returns, over $6 million in refunds. And again, we're still calculating those are rough. Paper returns will still be tabulated probably for the next 4 to 6 weeks. We're still working some of the rejects, and we've got some of our other sites that are still kind of reporting in. But it was a good season. One thing we've had to face in Missouri is some kind of disturbing realities. We've got a reduction a little bit in our extension footprint. Our family financial education specialists in Missouri, we've gone from 18 of them across the state to about 10. Missouri still runs on a specialist model where you have campus-based specialists like myself who kind of provide support to the regional specialists. And so back in 2015, we had about 18 openings across the state. And with our budget cuts and with the hard fiscal realities, we've dropped to 10, basically. And that 10 is probably a hard number for the foreseeable future. I don't think we're going to be going above 10 in the short term. That kind of corresponds with the enrollment at the University of Missouri. In 2015, we had about 35,050 people. And you might have seen us in the news in the fall of 2015. Had some negative press, had some events on campus, and the negative press that went with it. And so now our enrollment is about 5,000 less. We're about 30,870 in 2017. Now, enrollment is scheduled to pick up for the fall, but that enrollment drop affected extension as well. And so we're kind of existing in this new normal of reduced budgets, but you still got to produce, you still have to provide this education. And I hate the word new normal because it has a finality to it, but I think in this case it fits. We're not expected to really come out of this situation and revert back to what we had. And I think that's something that universities everywhere are facing. So what we're doing is we are making a shift. Traditional VITA is all about the one-to-one, face-to-face model where people are, the clients come in, they fill out some forms, they bring their forms with them, and then they sit down with a preparer and the return is prepared and they walk away from the site. The site prepares or finishes the return, sends it to the IRS, and then works the acknowledgments. So was the return accepted, which is great because we're done. We don't have to do anything else. Or was the return rejected and we've got to figure something out. About 15 minutes before the call started, or before the webinar started, I got a call from a client who was filing a return, and she was claiming her 15-year-old niece, and the return had rejected because the 15-year-old had filed a return claiming herself. That looks like a classic example of tax fraud, where someone is using a person's name and social to file a return on their behalf and claim something. So we're going to have to work with that client and do identity theft affidavit and fill out all this stuff. So it's a lot of work to run a traditional VITA site. You're taking on a lot of responsibility. Now the IRS has traditional VITA, and they offer this other thing called facilitated self-assistance. And so just like regular VITA, you have volunteers that have to go through a certification process. And that is a series of exams that are not that difficult. In fact, if you embrace it, it's a lot of fun. It also involves a location. So people need to come to a location that has computers and other capital equipment so they can prepare their return. But the responsibility lies with the individual. So that that individual sits down and prepares that return and actually transmits it. So that's really useful because you don't have to take on all those extra steps. It's on that individual to make sure that everything is finished and transmitted. We, as the site managers or the volunteers, can help that person, absolutely, but it does put that burden on the client. And that makes for much easier site management. You don't have to have all that acknowledgments coming back, working rejects, etc. And I think also people need help with their self-filing. So I'll give you two examples here from this tax season. Yesterday, I was working with a family and happened to look at their return, and they claimed $17,000 in personal property taxes. Now, if you're not familiar with Missouri, I think I have a 2009 Kia Soul, and I pay like $100 in personal property taxes. It's not very much. Usually your personal property taxes are generally fairly low. Usually somebody who is extremely wealthy might have maybe 1,000, 2,000 or more, depending on what they had in their garage, boats, etc. This person, I think their income was about 23,000, and they listed 17,000 in personal property taxes. So that's a problem. We helped them amend that and fix that. She had bought a new car, and I think she had just entered the 17,000 in because she saw a field that asked for it. And so there's still some education there. People still need a little bit of guidance. And I think as volunteers, we can kind of step in when they're done and say, okay, yeah, this looks reasonable, or say, wait a minute, you're making 23,000 and you're itemizing 19, something's not right there. Another example would be we helped a client who had used a very popular free service, and their Missouri was a little bit different from what we said. And we looked at it, and the free service actually, one of the IRS Free File Alliance players, they were letting the person select 2 boxes on the Missouri return and put in a deduction that they weren't really eligible for. And so there's a lot of confusion when people are adding information, and still some of the services may be a little bit messed up. And so I think people need help even if they're preparing their own returns. So we're making a shift a little bit with this facilitated self-assistance. We're not requiring an NFV specialist to run these sites. It's handy to have it, absolutely, but it's not required. What we're looking for is a strong community connection. And at University of Missouri Extension right now, engagement is the word. The Vice Chancellor for Extension is really pushing engagement as something we need to do. We need to be engaged in the community. We need to have strong connections, strong roots. It's helpful to have strong volunteer commitment. So we've got to have somebody who's committed to coming throughout the season. And we still need a location, volunteers, and marketing leadership. So those are things we need. What you don't see there is you don't need to have a heavy background if you're facilitating the site in tax law or tax software. Those kind of responsibilities shift a little bit once you're not taking over that transmission and that acknowledgement role. So we're making this shift to facilitate self-assistance to many more MU Extension employees than just our family financial education specialists. And in that transition, as a campus-based specialist, I provide these pieces. So online trainings for tax law and tax software. The IRS does have a online training, but it's a little not as interactive. It's got some other kind of static, dull, maybe adjectives are good to use. It's just not that great. And so we're going to be developing an online training that's more interactive, more exciting, that type of thing. We will provide capital equipment, and really that means Chromebooks. What we've found is a traditional laptop, if you buy it from the university's approved suppliers, usually costs you about $1,000. Sometimes you can knock it down to about $800. I can buy Chromebooks for about $200 each that are great. People love them. They may not be the Chromebooks you're familiar with. These Chromebooks, I try and get larger screens because many of our volunteers are older. They are retired. And they don't want to look at an 11-inch screen. They want something that's at least 13, hopefully 14 inches in size. But the Chromebooks, they self-update themselves. They're just so much better from a tech support standpoint. And campus would also provide tax law support and tech support. And how we do that is I give my cell phone number out to the sites, and That number rings my office, my cell phone, and my home phone. So I try to be available ASAP to people when they need it. And that makes a lot of sense. If you have a client sitting there in a traditional VITA site, you need an answer right away because that client wants to know what's going on. They don't want to wait for somebody to call them back in an hour. So we provide very quick service. One of the ways we've facilitated our work is through the IRS grant. This grant is extremely competitive. It is oversubscribed by about twice. So usually there's a $15 million offering and about 30 million people apply, or not $30 million worth of budgets apply. We've applied quite a few times. We never get everything. We're always cut. And that just boggles my grant writer. She's like, how can you put a budget in and then the budget just gets cut, although the responsibilities don't? And it's just like, well, that's just the way the IRS rolls. And it has very difficult scoring. It is currently in a 2-year cycle, so we are actually opening up May 1. The VITA grant season is, and so we will be applying this year. Closes at the end of May. We've been successful about 8 of the past 10 times. We weren't successful the first time it came out, but then we were successful in the next year, and then we also lost it somewhere in there, and then we picked it back up again. So we've had quite a lot of experience. We've just gotten really good at applying for this grant. So in talking about the grant last night and kind of reviewing this presentation, I was thinking to myself, we do need more sites in Missouri and maybe elsewhere. And so just today, on offer for the next 24 hours, I would like to propose that anybody who would like to partner with University of Missouri Extension to offer a facilitated self-assistance site, I'd love to have a discussion about that. And I'm kidding about the 24 hours. There's a lot of stuff going on. That was just again, try to interject some tax humor here in taxes. At MU Extension, we would provide capital equipment, online training, tax software support, tax law support, and even a state-specific training. So especially for states like Texas and Florida, we'd love to provide your training for your state income tax. That's also a joke because Texas and Florida don't have state income taxes. So, all right. So basically the same offer I would make my specialists in the field, I'd like to offer to anybody. I'd like to have a conversation and see how we can leverage what MU has done with your state. So as partners, we need location, volunteers, marketing, and management. The location can be anywhere. It could be a library, could be an extension office, could be a local community college or other educational institution. Volunteers can be the same from anywhere. We see a lot of retirees in the Branson area. We see a lot of homemakers up in the Northeast. And we see a lot of college students here at MU. So, and it runs the gamut in college students. We have accounting students, we have law students, and we have personal financial planning students. They really value the experience being able to sit down, talk with someone about money, and deliver good news, deliver bad news. And when they go interview, when they talk to employers, they can say, I've had to say to someone, you're only getting $2,000, you're not getting the $4,000 you expected. And here's why, and explain it to the client. And that's something that a lot of their peers just don't have. Marketing is just something that every extension person knows, just getting that word out. And the management is mostly the management of the volunteers and making sure that the local partners are having their needs met. So if you're at a library, do they have everything they need? Is everything set up? Does everybody understand? So basically, many of the facets of extension programming everywhere is the same thing that facilitated self-assistance sites use. So just throwing it out there, if you're interested, you'll have my phone number and my email address at the end. So I'd love to kind of talk more about this opportunity if anyone is interested. Oh yeah, there's my phone number right there. And again, that 24 hours thing was just a joke, just trying to interject some humor into taxes. I don't know who that person is. I found that on the web. It seems like all of the sketchy sites have the really attractive person with the headset. It's like, call me now, talk to me. And again, just kind of some humor there. Okay, so we've talked about some of that postcard philosophy and the idea of simplification. We've talked a little bit about MOTAX and the opportunities, what Missouri does and the opportunities maybe for expanding outside Missouri, kind of putting that offer on the table. And finally, we're going to jump into some of the tax changes. And It's called an act to provide for reconciliation pursuant to Titles 2 and 5 of the concurrent resolution on the budget for fiscal year 2018. I think it was the Senate parliamentarian didn't like the original name, the Tax Cuts and Jobs Act, and so they had to change it last minute to get it through. Everybody calls it the Tax Cut and Jobs Act, but it's hilarious to me that this was their solution, is to put in this crazy title for the bill. Also, we've talked about simplification. We're going in the opposite direction here a little bit. So taxes are getting a little bit more complex with some of these changes. So for 2017 and the tax season we just finished, there really wasn't much change. Pretty much the only major change was there was a 7.5% floor for medical. So if you're itemizing, you had to get over 7.5% of your adjusted gross income in order to be able to itemize. That was 10%. That had been phased in with some of the changes that went through with the Affordable Care Act. And so they brought it back down to 7.5%. That's where it had been for a while. And now it's 7.5% for 17 and 18. It will have some major impacts in 2018, and we're going to spend a lot of time talking about those, and then major impacts coming up in 2026. So we're definitely going to be talking about these. But first, let me pause for a second. Are there any questions? Kind of trying to watch the chat with one eye.
And I'm keeping an eye on the chat as well, and I've put in a couple of those links in there. I put in Andrew's contact information, and also feel free to use the Q&A for any questions we have ongoing. Andrew's built into his presentation a couple of little breaks to take questions, and so, but you can feel free to go ahead and put those in the Q&A anytime, and I'll monitor that as well as the chat. And if nothing further, we'll go on to the next section of Andrew's presentation. Thanks, Andrew.
Absolutely, absolutely. Okay, so jumping into the Tax Cuts and Jobs Act, the biggest piece that we've seen in the VITA sites is that people believe they don't have to have health insurance for 2018. And so people have said, oh, I don't need to worry about that. Trump repealed that. And it's like, well, no, that repeal starts in 2019. You still have to maintain health insurance for 2018. And so we've been talking to individuals about some of the strategies they can use. We've had to, just kind of talking a little bit about the tax penalties. We've had a few people this year where their income was about $200, $100 over a limit. And so if you're in Missouri, we didn't expand Medicaid, and so you can make about $16,000 and not pay the penalty. Well, someone was $100 over that line. So I said to them, if you go to your credit union or bank, you could open up a traditional IRA, deposit $100, get your income below the threshold, and you won't have to pay the $700 penalty. And that's what we had people do. Now, it's not been easy. A lot of our clients are lower income. They may not understand traditional IRAs. When we sent them to the credit union the first time, the credit union's like, well, you should open a Roth. It's a better deal for you. And we had to be like, no, you don't understand. We're doing this because of the healthcare and the penalties. And so we've kind of had to help people jump through some hoops. But I'm kind of hopeful that in 2020, when we're filing the 2019 returns, we can just leave all this behind. So tax preparers everywhere, we're excited that this was repealed because of the hassle it was to work with clients on. That was the kind of the main point for tax preparers, although it may cause problems with people being required to have health insurance and the marketplace and what the health of the markets actually look like and what that does to the premiums. That was kind of in the future a little bit, or more intangible versus not having to worry about getting people exempt from these penalties. The standard deduction doubles. So for married filing joint, it goes up to $24,000. Single is $12,000, and head of household is in between there. Now that standard deduction doubling is offset a little bit because exemptions are now gone. The $4,050 that people use to offset per dependent on their return, that is now gone. There won't be any exemptions. To help offset the exemption loss, the child tax credit doubles to $2,000. So if you were receiving $1,000 per child, you're now going to receive $2,000. And that's pretty awesome. A lot of large families are excited about that. Just a few caveats. You must have a social security number. Here at the university, it sounds like the fire alarm is going off. You know, it just had to be an exciting webinar. If you don't mind, I'm going to go check on that. I'll be right back.
So while Andrew is out, I'll just speak to a little bit the first point on there about the shared responsibility payment, and just a little background on that. With the Affordable Care Act that was passed during the Obama administration, or Obamacare as it was lovingly or sometimes not lovingly referenced, part of that tax was a penalty for those who didn't have health insurance. Are we, we need to unmute. Andrew, are we good?
Yeah, so the building is not going to burn down.
Okay, so good. Just as long as you're not staying in a burning building to present our webinar. So thank you. Glad to have you back. Carry on.
I am dedicated. I don't know if I'm that dedicated. So it did shut off as I kind of walked in the hallway to see what was going on. So this is the best. Thank you, Ashley. Yes, this is the best. Where was I? Oh, you must have a social security number. So we have a lot of clients here at the university who are here, and generally it's a postdoc who comes to do research here at the university, and so they will bring their families over with them. And so there'll be the spouse and the children, and after a certain period of time, depending on the tax rules, the spouse and the children are eligible to be claimed on a return. But they're not eligible for social security numbers, so they have to get what's called our ITIN, an individual taxpayer identification number. ITINs have had kind of a negative history a little bit. The IRS was maybe handing them out too freely, and so they cracked down, and now it's harder to get an ITIN, and they've been restricting the benefits available to ITINs. So this child tax credit, it doubles to $2,000, but for our families who are here that don't have an ITIN don't have a social for a child, but have an ITIN, they're only going to get a $500 credit. And other dependents who aren't children, so if you're caring for an elderly parent or a friend, that type of thing, that's only going to be worth $500. So a little bit of a difference there. It may not be worth it as much to claim someone on your return if the credit is only $500. There are some new lower tax rates, and I'm not going to go through each and every one of those, but every tax rate was lowered except that initial 10% rate. And so again, losing the exemptions can hurt people, but some of that will be offset by the lower tax rates. So you're going to see this. We've got a few more pages of these changes. It's not clear that everybody's going to be better off. There are some people who are going to pay more. I can create a scenario where things get pretty bad for someone, but I can create scenarios where things get really good. Like it's not clear exactly who benefits, except maybe the people who have much higher incomes. I think they do reap much more of the benefits. Okay. One other piece is the 20% deduction on net income from taxable. And so that's a very vague sentence. Let me elaborate a little bit. If you have a small business that is a pass-through, so things like a partnership or a sole proprietor that you're engaged in outside work, then you can actually deduct 20% of your profits from your taxable income. Now, I've written that sentence very specifically because that 20% deduction, it would make sense if that was done kind of closer to the net income line. So why not just take net income, subtract 20%, call that new net income? That would be awesome. But no, that's not the way they did it. They said that 20% of your net profit can be subtracted from your taxable income. So a lot of people have kind of guessed or thought that the exemption line is going to disappear on the back of the 1040. Maybe they'll put in the 20% deduction there. And so we can't count on this 20% deduction to affect AGI. And so a lot of other factors, like all the items that have phase outs, they're not going to benefit from this 20% deduction. It's also limited if your income is below 157,500, then you don't have to worry about any other limits or categories of employment. Or if you're 315,000 married filing joint, then again, you don't have to worry about it. If you're above those limits, then you're gonna have to meet certain rules on what is your occupation, is it based on you and your celebrity, then you're gonna face some limits on this 20% deduction. So for most people, they're gonna get this 20% deduction and they're gonna be like, this is cool. But for the higher income individuals, they may face some more obstacles. Just as an aside, if you're thinking about starting some consulting work on the side and your income is below these limits, you might want to consider becoming an independent contractor versus the traditional employee-employer route because of this 20% deduction. There's a lot of analysis going on. A lot of people are converting their kind of regular employee-employer job into independent contracting or pursuing partnerships to take advantage of this deduction. So there's been a lot in the Wall Street Journal and other media about this opportunity. 529 funds. So this is the higher education funds. Almost every state has one of these. In Missouri, we call it the Missouri Most Plan. These funds can now be used to pay through K through 12 education. So this is a huge boon for families who are maybe employing private education, private schools, parochial schools to send their children to. And so in Missouri, there's a lot of talk about maybe putting some restrictions on this because people are funneling money to the 529 and then taking it right out to pay the expenses. And so maybe there should be a requirement that the money has to be held for a certain period of time. You know, are we just losing income tax revenue because people can funnel the money through this special account, almost like a flex spending account? And was this really the intention? So a lot of discussion around that, but 529 funds can now be used through K through 12, including private K through 12. Itemizing is a lot harder. Most of your miscellaneous expenses are gone. So your safe deposit box charges, your tax preparation fees, your investment management fees, all those little fees, the union fees, the unreimbursed employee business expenses. So if you had to travel and your employer didn't reimburse you, this would affect University of Missouri folks. We get reimbursed at 37 cents a mile versus I think it's like 54.5 from the federal. So technically, under the old law, we would be able to deduct the difference per mile between the rate we get reimbursed and the federal rate. That's gone now. It didn't add up to a lot unless you traveled, you know, tens of thousands of miles, but there were some people, traveling salesmen, who they were able to deduct that difference, but that's all gone. State and local income taxes limited to 10,000. I know we've got, I think we had Barb O'Neill, if she's still there. I know she's really excited about that. She thinks that's a wonderful idea. Just kidding, Barb is from New Jersey. They tend to be a higher tax state, and so a lot of people in the high tax states are upset about this. They pay high income taxes and or high property taxes, and so this is really going to hurt them when they go to itemize. A lot of press I've seen about home equity lines of credit and the interest no longer being deductible. That's mainly true if you used your HELOC for things other than your home. So if you took your HELOC out and used it to send your kid to college, if you took out a HELOC and bought a car, that might have been a great idea because you could deduct the interest, but still use it for something unrelated to your house. Now, if you're going to deduct HELOC interest, then it has to be related to your home. So you've made a major improvement to your home. Maybe you've added another room to your home, that type of thing. So HELOC interest, when you read that it's no longer deductible, that's not exactly true. It's just HELOC interest for things not related to home acquisition or improvement are no longer deductible. So there's some confusion I've seen out in the media about that. Also, something that we saw here at the university, many donors would give to our scholarship fund, our athletic scholarship fund, and they would get seating rights that came with that. And those donations were deductible up to 80%. And the law basically removed that provision. And now if you donate to the scholarship fund for athletes, you'll still get the seating rights, but you won't get the tax deduction. So that may impact some of the fundraising efforts of higher educational institutions. And moving expenses are no longer deductible, but you'll notice there I've got in parentheses PCS. This is no longer deductible unless you're in the military and you are engaging in a permanent change of station. And so they put a little carve out there for the military since they are moving so often between bases that they are still going to be able to deduct their moving expenses. I didn't put this in the slide, but kind of alongside this moving expenses no longer being deductible, if your employer reimburses you for moving, previously that was not considered taxable income, and now it will be considered taxable income. So if you're considering a job change and your employer is offering to cover your moving expenses, know that that's going to be rolled into your W-2. So that is coming. Barb says, I'm coming out ahead due to a higher standard deduction. Still moving to Florida. There we go. Absolutely. So talking a little bit more about the Tax Cut and Jobs Act. Sadly, a lot of these changes, they revert back in 2026. So for example, the exemptions return. They will be adjusted for inflation, but they do come back. Many of these items are considered suspended. They're not repealed. And so in order to pass budget provisions, they had to end some of the benefits early. And so in 2026, the exemptions return. The standard deduction reverts back. So it was doubled to $24,000 for married filing joint, $12,000 for single. It will go back to its inflation adjusted number in 2026. Many of the corporate changes though stay. So we didn't cover those today, but a lot of those changes were made permanent in the law. And what Congress is doing is they were kind of making a bit of a gamble. The Bush tax cuts that came in during the Bush presidency, they were set to expire 2008, 2010, and those were made permanent for people with incomes below about $250,000. And Congress said, basically, well, we need to cut these off to make sure we can pass the budget restraints. And we're betting that a future Congress, when they're in office, is not going to let these provisions expire. People will get used to this really nice child tax credit of $2,000. They'll like their standard deduction being doubled. And so we're going to let a future Congress figure out how to pay for these in the 2020s. And so hopefully something happens by 2026 and we don't have to relearn all these old rules again. Now, one thing that will stay with us and is not changing, but is not talked about too much is chained CPI. And so we know all the tax numbers are inflation adjusted. So the tax brackets rise with the inflation changes, things like the standard deduction, the exemptions. It's fascinating to go back and look. When I first started in VITA, the exemption was in the low 3,000s, and now it's up to 4,000. And that's just the effect of inflation over time, kind of pushing that exemption up. So inflation has made a difference on tax returns. That inflation has been calculated at wage rate inflation. And that has been a little bit more generous than other calculations of inflation. And so we're moving away from that kind of more generous consumer price index calculation to a chained CPI. And this chained CPI, it takes into account substitutions. So if a good gets too expensive, people will shift to consuming other goods, and that price of the other good is considered in the CPI, and that causes less of an increase, basically. And so the change in inflation is going to be smaller every year. And you might think, well, inflation isn't that great. It's not a big deal. Some government agencies have estimated that it's going to cost us, I forgot to put a billion in there, 128 billion over 10 years. So it's definitely the difference in the calculation of inflation is definitely going to cause an increase in revenue, and it's going to cause a change to people's tax returns. But they won't feel it except slowly and over time, just like the frog that you put in a pot of water that you slowly turn the heat up on and you cook instead of just kind of dousing it from the beginning. Didn't think you'd get the boiling frog analogy in a tax presentation, but there it is. Kind of goes with the fire alarm. Okay. Now, that I just had 2 or 3 slides, and I know I don't have a ton of time to talk about these items. There are 2 great resources out there. First one is Iowa State University's, their Center for Agricultural Law and Taxation. Don't worry too much about the word agricultural there. They do cover a lot of ag stuff, and that's interesting, but they do cover a lot of just general tax as well. So they had a really good kind of review in early January that kind of covered some of the tax pieces. So I think they've got some great stuff there. And you can't really talk about personal finance and experts and great coverage without talking about Michael Kitsis, the Nerd's Eye View blog, and I've got the shortened link there. Excellent job. It's a great overview of the tax changes with some analysis about what's going to happen, the changes that are going to take place. He just does an excellent job. If you're not subscribed to his blog, I would highly recommend it. He puts out some of the highest quality stuff that's out there in the field. Okay, and I know I'm about 9 minutes away from our end time, so that's good because I'm only a few slides away from the end. Wanted to talk a little bit about the ACA. ACA, you know, when I heard that Trump was elected, I thought, all right, ACA is gone. It's not, they're going to repeal it. It's going to be a Republican House, Republican Senate, and the White House. They control all the branches. It's going to be gone. And it didn't happen. I was actually shocked a little bit. Maybe I shouldn't have been. I don't know. But ACA is here, and it's probably here to stay, maybe I would say. It seems like the will to repeal it, the push to repeal it, it's kind of died out a little bit. We're not hearing it talked about in the media. There's not a lot of moves going on. And so ACA, now that it's here, has some implications for retirement and has implications for a lot of people. But I think there's a lot to look at in retirement because people always had this temporary view of it. But now that it's here and it's not going away, there's some opportunities here. And so the ACA, just to kind of do a quick overview, provides premium tax credits to help offset the cost of health insurance in a marketplace. So either the federal marketplace or your state marketplace. And the premium tax credits are based on a benchmark. And let me dig a little bit deeper. The benchmark plan, what you pay is based off your income, and then what you receive is based off of the benchmark. And it took me a while to kind of really sit and think about this and say, wow, that's deep. What you pay isn't based off of the benchmark, it's based off of your income. So I've got a 2-person household here, and their AGI or MAGI is $42,600. Now, I made this person up. That's 250% of the federal poverty line, so they're eligible for cost share, which means they will have lower deductibles and lower out-of-pockets. And those cost share provisions are eligible for people who make less than 250%. Now, just looking at that 250% and the corresponding table that shows how much of their income should be paid based on the 250% of federal poverty line, I can tell you that their premium is going to be $277. And that's it. If they bought the benchmark, they're just going to pay $277. So it doesn't matter what that benchmark is, whether that benchmark plan is $800 a month or whether it's $300 a month, that person is only going to pay $277. And so it's important to remember that what you pay is based on your income if you're buying the benchmark plan. So a retired couple could purchase a plan and they're only going to pay this $277. And if they stay below the $250, then they're getting the benefits of cost share, the lower deductibles, the lower out-of-pockets. And that can be for 1 or 2 persons. It's kind of weird, but this 277 is calculated based on the income of the people in the household and the number of people in the household. So whether one person is on a plan in the marketplace and one person's on, let's say, Medicare, or whether 2 people on the plan, they're still going to pay $277 monthly premium for a bench. You're still only going to pay a $277 monthly premium if you buy the benchmark. Now, of course, your monthly can go up or down if you choose a lower metal plan or a higher metal plan, but that silver plan with cost share is very attractive. So the key to this, making all of this work, is the modified adjusted gross income of $42,600. So how do we hit that? Well, let's look at what makes up MAGI. MAGI is just your AGI, your regular AGI. So your earnings, your, say your pension distributions, et cetera, all that stuff, bank interest, et cetera, plus foreign earned income. Well, we don't see much of that. Tax exempt interest. Okay, they always maybe see a little bit of that. And then untaxed Social Security income. So if someone is taking Social Security early, they may blow past the $42,600 with their untaxed Social Security, especially if it's a two-person household and they're both taking Social Security. You lose the ability to manipulate income if someone is taking their Social Security a little bit. You're going to have a harder time. So what is not included in MAGI? Well, that's Roth income, and if you have taxable accounts with small gains. So we talk a lot about retirement accounts and putting money in your 401k, your 403b, and your Roth 401k, your Roth 403b, your Roth IRA, your traditional IRA. And we talk a lot about you put money in and it's really useful to pay the taxes now if you're in a low tax bracket. And then later on, when you're in a higher tax bracket, you can take the money out of your Roth and use it to fund whatever. And we kind of do this tax arbitrage. And we say it in reverse a little bit. If you're in a higher income bracket, you put money in your pre-tax accounts, your tax deferral accounts. So you save the tax money then. And when you retire, you're hopefully in a lower bracket and you take the money out and you pay lower taxes. Well, we're seeing the benefits of being kind of tax diversified. And so I've seen a few people where they're able to manipulate their income to keep it at that $42,600, get the cost share built in, but still have a nice lifestyle because they're pulling money out of these non-taxable sources. Things like the Roth IRAs, the Roth employer-sponsored retirement accounts, or they've got taxable accounts with small gains. So someone who had a non-qualified retirement plan, and so they received a lump sum when they retire that they've already paid the taxes on, or if someone has inherited something, and so at inheritance, your cost basis steps up, and so you don't have much gain generally on inheritances. So being able to fund retirement out of these non-taxable accounts or low tax accounts can really help steer your income when you go to the marketplace and apply for insurance. So we talk a lot about diversification of assets and maybe even time diversification. I think it's useful to talk about tax diversification. So maybe it's useful to have a little bit put in that Roth account, even if maybe in the old calculations, it's better to put it all in the pre-tax. It's helpful to have options when you get to later in life. So just kind of throwing that out there as a last minute, something for you to ponder. And I believe I'm 3 minutes away. So there is kind of my information at the bottom. Again, if you want to talk about hosting a facilitated self-assistance site in your state, we can definitely have that conversation. And if you want the PDF of this presentation, it's at that Google shortened link there. That is case sensitive, but that will take you to a PDF of everything today, minus fire alarms.
Okay, thank you so much, Andrew. I've tried to put some of the links in the chat as we talked about them, just those that were available that I could grab hold of pretty easily. And just a couple of minutes out, but any questions for Andrew before we sign off today? Just feel free to go ahead and put those in the chat. I have that open. We're monitoring for those. While we're waiting to see if there's anything else, I'll remind you that our next session is going to be in May at this same time. It's May the 23rd is the date. That's Kamur Imam is presenting personal finance education in Arabic is going to be the topic for that May session. Thank you so much, Andrew, for joining us today. That really completely filled the bill for what I wanted you to talk about. Great webinar I'm seeing in the chat. So I agree completely, Barb. Thanks so much, Andrew. So if there's not anything else, we have just a couple minutes, just about a minute left. Looking to see if there's anything else coming up, and reminding everyone also of the YouTube Live Money Smart Week event and Twitter chat this afternoon. Look on social media for those announcements from Barb O'Neill and from others in the community about that Twitter chat and YouTube Live event celebrating Money Smart Week. You can probably find that at hashtag Money Smart Week in any of your social media. Great job. Much appreciative of your sense of humor, Andrew. Just a great go-to person for information and entertainment during a tax presentation. Thanks.
You got to make taxes fun. If taxes aren't fun, then who's really going to pick it up? So, and I did not pull the fire alarm. I did not schedule that. That was totally by surprise. But I will add that.
Unintentional fire alarm. Thanks everyone for joining today. Bye.
Take care.